strategist Phil Blancato. Phil, you and I have had these sort of conversations before. Oh. So I had this chart yesterday, going back to 2015, going by the old rule book, cheap stocks, low valuations, low PE ratios. So, okay, 19, 12, 16, 10, 15. Exxon, GE, IBM, and Shell. The ones that had these crazy valuations, Adobe, Amazon, Facebook/Meta, Netflix. You would never buy those stocks. You would never buy them by the traditional Wall Street handbook in 2015. And yet, if you bought those in 2015, you're watching this show from a yacht if you're bothering to watch it at all. I mean, is it time to rethink all of this?
No. Here's why. Let's not forget what happened in the last 10 years. We had very low interest rates, so there was no reason to go out and buy the dividend players. What you bought was you had this fuel that you fuel long-term growth with very low interest rates, and that's what these represented. Not only were they great companies, and we know they changed the way we live, take our entertainment in, maybe shop, but they also were able to debt binge for next to nothing, and that created a fuel that ran. And I think that's changing now. And the reason why is I agree with everything you said, except we still got to finance 101. We still got to take profits when we see these names that have gone up. Robinhood, 200, 300%. Netflix, and any of these, one less degree Amazon. But certainly today, NVIDIA.
But here's the thing. You take profits and what? Put it in Exxon? Exxon, it doesn't move.
But don't sell it all. But go to why not have a dividend that's going to help you smooth out some of the bottom? What does well as interest rates come down? Banks.
Is it a one-for-one barbell?
It's not.
Okay.
It's not. What you want to think about is where do I want to do? I don't want to do just in large cap growth, but if you're 35% of your portfolio large growth and you're 20 in large value, that's a nice barbell. It's a pair trade. You know what the bond market is up this year? Nearly 8%. So why not own a little fixed income that'll cushion you? I think we're falling too in love with this is going to go on forever. Let's not forget.
Not forever. I'm just saying this window, particularly the fourth industrial revolution, this window at this particular time, it happened in the 1800s. Here's the thing. In the 1800s, with the so-called robber barons and the market took off and we had all those inventions over a 40, 50-year period, the average stock on the New York Stock Exchange only had 1,100 shareholders. Now, everyone watching this show could be a shareholder. Everyone watching the show, in my opinion, could be a modern-day robber baron, because I don't think it's going to be like this. I think we'll revert back at some point to where you want to maybe go back to the old playbook. But while we're in this environment, I just think you got to seize it.
It's hard to make a $5 trillion company can become $10 trillion, NVIDIA. So what's going to fuel NVIDIA? What mid-cap growth
stocks on this show this year that have gone up more than NVIDIA, but they didn't start at $1 trillion, right? They started at $100 million, and then they go to $1 billion. But you, ironically, though, you're telling folks you're looking for the NASDAQ to blast off from here.
I am, because I don't want to be just in those seven. So maybe I'm saying it wrong. I think if you made a bunch of money in those concentrated NVIDIA, you see it take some profit, and I do want you to go where you're seeing earnings growth, because you're starting to see other companies succeed. Mid-cap growth companies, companies that are in the NASDAQ that are doing, whether it's the power, the pieces, the chips, that to me.
The story is broadening out.
And that's the most important part of this, that we can have success not in just those names. I want to see the pivot.
I like that you mentioned the balance sheet, because I don't think enough individual investors focus on balance sheets.
Exactly. And so what I want folks to do is maybe remove yourself from the euphoria of Palantir, which is more of a story than revenue. And they make great revenue, but their valuations are through the roof. When you look at balance sheets, and you don't have to have a pristine balance sheet, but you do need revenue growth coupled with debt management. You want your PEG ratio, how much the company is growing about, we talked about this a couple weeks ago, to be in a growth mode and not overly expensive.
Real quick, one of my favorite guests, she'll be on tomorrow, Beth Kindig. She was probably the first person I saw pounding the table on NVIDIA years ago. Now she's gone to a $20 trillion valuation by 2030. What do you think about it? They're reporting after the bell. What are you expecting?
I expect blowout numbers again.
Yeah.
10 trillion is a big number. 20 trillion is a max. There are other players in the space that are catching up quickly, but let's be honest, there is one game in town right now, and it's NVIDIA.
Well, also, let's be honest, this guy is a visionary. So while everyone's catching up to this game, he's inventing a brand new game. He invented the GPU game. I want to give you some props on this. You gave us this like $20 not long ago. It went to 100. It's pulled back. Are you still in it?
I'm still in it.
MP, okay.
It's a revolutionary change in how we power the United States.
It's amazing.
It's happening. If you're not part of it, you're making a mistake.
The picks. 3M, Capital One, and Dominion Energy. I think we kind of know the story here. 3M I hadn't heard in a while. Every now and then they come through with a pretty good earnings report. It feels, again, like one of those old stodgy names. Why do we like it now?
Because the biggest data center in the world is being built in the United States. It's going to be bigger than the size of Manhattan, and they're going to supply parts for it. That's why. In a world with data centers coming out, that's why you do it.
Good stuff. Love these conversations, my man.
Thank you.